So we're going to talk about some applications of the asset pricing empirical methods we've been using. And one of the main applications is the performance evaluation of mutual funds, hedge funds, and so forth. And it's also a good place to see the techniques. I want to do this by looking at a couple of really specific, very classic papers. The results and methods are still exactly the ones used today. So let's go with a question. What are these papers after? What's Carhart in particular after? We're looking at a mutual fund. Does the manager have skill? Can the manager find underpriced stocks? Does the manager have information about asset prices that isn't already reflected in market prices? Or can I replicate the manager's performance just by using easily tradable indices, and so I don't have to pay the manager his fees? Now, before you get too cynical and jump to the answer, remember what you'd expect here. What you might expect is that it's natural and completely sensible, and it might be good marketing for MBA programs, that funds outperform random portfolios. In every other field of human endeavor, seasoned professionals outperform amateurs. And you should expect that. Now, wait a minute. There's competition and there's free entry. So maybe the average fund isn't any good. But surely the good funds should be good, no? Well, let's go look at the facts. So let's jump to Carhart. Here's his table 3. This is the table of the facts. What did Carhart do to answer this question about skills? So column 1 of the table, portfolios 1A through 10C. What's going on here? What Carhart has done is he has sorted all the mutual funds into 10 portfolios and then 3 sub-portfolios at the top and bottom ones according to their performance in the previous year. Then he's going to look at the performance of those portfolios over the following year. So Carhart is doing for funds exactly the same thing that Fama and French did for stocks. Sort them into portfolios and then watch the returns of the portfolios. Now, why is Carhart doing things this way? Well, one of the central questions we have to answer is to distinguish luck from skill. You can't ask the question, what about Warren Buffett? Medicine doesn't ask the question, how did you get so old? And finance can't ask the question, what about one particular guy? Because we don't know if he was lucky or skillful. So how do we separate luck from skill? 2 techniques. Number 1, you have to include all the dead funds. If you just look in the phone book today under mutual fund, you'll get the survivors who are the ones that have done well. The second thing, and Carhart did a lot of hard work to get all the dead funds in there. The second thing you have to do is if you want to find the good funds from the not so good funds, you have to sort them into a portfolio based on something you could see at the time and then watch all of them going forward. And that's what Carhart has done. He's sorted them all into a portfolio based on the previous year's returns. There's the good ones, there's the bad ones. But then we watch all of them, including the dead funds, for the following years. And that's our way of distinguishing luck from skill. So that's the portfolios. Let's look at what happened. These are portfolios, the ones that did well last year and the ones that did poorly last year. Let's watch what happens over the subsequent year. First, the next column, monthly excess return and standard deviation. This is the return of the portfolio of funds, and you can see something very interesting. The funds that did well in the previous year do 68% per month in the next year, whereas the funds that did poorly in the previous year do very badly, only 1% per month the next year. In fact, the bottom 30th of funds in the last year managed to lose 25 basis points a month through the next year. That's pretty astoundingly difficult to achieve. How do you form a portfolio of equities that actually loses relative to bonds in the next year? Now, this is very interesting. You might have thought it doesn't matter what funds did last year. They're all going to do the same next year on average. There's a lot of risk. The next column shows you the risk. The standard deviation column shows you there's a lot of risk here, but still, on average, the good funds are doing well. Wait, I thought it didn't matter. Well, it turns out it does. Funds that did well last year continue to do well for the subsequent year. And this was one of the major findings of the fund literature, that in fact there is some persistence in the return performance of mutual funds. Well, does that mean that we've finally found skill? That we found hot hands is the name that Carhart referenced the literature talking about this, that we've found a group of funds who really know what they're doing and you should pay them for their 68 basis points. Well, maybe not. Maybe what we found, as always in asset pricing, is that this is a group of funds that have really high betas in their portfolios. that they are really exposed to risk. They get the high average returns because of high betas. How do we solve that question? Well, we run the CAPM regression on these funds. So the next set of columns shows you what happens. Do the high average return funds still have high alphas after we adjust for CAPM betas? Maybe they're just riskier. The answer is no. The CAPM is a failure here, as it has been before. The betas, notice, are all about 1, 1.03, 1.0, 0.99. The betas are all about 1, and therefore the spread in average returns, the spread from 68% down to 0.1%, is the same as the spread in the alphas. The CAPM is just doing not much at all to explain this average returns. Next, what Carhart does is he looks at a 4-factor attribution model. So here is the text from the paper where he explains what he's doing. A 4-factor model, RMRF, SMB, HML, and PR1YR. That's a new one. That's a momentum factor. Well, this is new, and this is a deep point of this whole segment. Why is it okay to use a momentum factor? Is that a state variable for investment opportunities? Well, no. And this is, we're asking a different question than we have before. This is a classic case of relative pricing versus absolute pricing. In our last segment, we thought about asset pricing models that could explain anything, that could generate any risk premium. Here, we're not interested in that question. We're only interested in the question, does the return of the manager, does the manager achieve something in his return that I couldn't get mechanically following a momentum strategy? Is momentum rational or not? I don't know, but that's not the question. The question is, momentum rational or not, can I get momentum, can I get this manager's return just by a momentum strategy, or do I have to pay the manager his fees to get the return? For the skill versus style question, these things here can be any portfolio that you can trade mechanically, not just things that should be real asset pricing models. 90% of applied asset pricing is relative pricing. And that means the models we use in this case are not that tied to all the derivations we did before for absolute asset pricing models. So it's okay to use momentum as a factor. Well, let's look at what we have then. Here is the 4-factor model regressions. You saw the pattern, average returns. There is a big difference in average returns. As usual, let's look at where does that correspond to betas. Is there a difference in betas? Not really. As you look up and down the market betas, they're all about the same, 0.8, 0.9. Is there a difference in SMB and HML loadings? Well, a little bit, 0.72, 59, 56, but then they're all about the same. As usual, the way to become really volatile is to invest in small stocks. But that pattern here overall of betas here is not really matching the average returns. The interesting pattern is in the loadings on the momentum factor. 33, 27, 27, 29, down to negatives over here. The loadings on the momentum factor match the average returns, leaving us alphas that are pretty much flat. Now the alphas aren't zero. It's interesting, the alphas are all about negative 10 basis points. And the puzzle in this paper is the surprisingly large negative alphas of the losers. The losers seem to be particularly bad in puzzling ways. That has been repaired in subsequent research with a slightly better momentum factor. But that's the basic result from Carhart. Yes, sort portfolios, sort mutual funds into portfolios based on lagged returns. That return persists for a year. Does that tell you hot hands? No, at least in the sense that I can replicate that performance by investing in momentum, in the momentum factor. It's explained by a 4-factor performance attribution model.